I'm loving this. I'm loving this. Thank you so much, everyone, for connecting with me, following us as usual. So, what I like to talk to you guys about this time, it's something more along the lines of what I consider, and I wrote it in this title, if it's written correctly. What are the key drivers of equities for investors to consider right now, this quarter? So, there are five different ways of looking at this: earnings, valuations, the US macro look, global growth, and US monetary policy slash inflation. So, what are the factors? And then let's understand the implications of for these equities, whether they are negative, neutral, or positive. So let's start with number one, earnings. That's a neutral. According to the FactSet, estimated the S&P 500 revenue and earnings annual growth rates in 2023, they were about 2.4% and 0.7% respectively. According this year, the consensus expects growth of 5.4 to 11.0%. For 2023, the fourth quarter estimates call for sales growth of 3.4 and profits growth of 1.5% on a year over year basis. This is what we call the YOY. In Q1 of 2024, as of now, the consensus expects growth of 3.6 and 4.5 respectively. Meanwhile, according to our internal global research, the global earnings revision ratio moderated in January in line with its historical early year tendency. The ratio remains below its long term average, while the number of downgrades to profit estimates surpasses upgrades. This means that globally, this scenario stands for 17 of 20 countries and in 15 of 16 tracked industries. Point number two, valuations. This is a little negative. And you know this because when you're doing your valuations, the numbers have gone down. So the S&P 500 ratio, PE ratio, over the next 12 months have risen to about 20x, the highest in about 2 years and above the long-term average. This headline measure suggests that US equities remain expensive amidst an outlook for slowing economic growth. Elevated interest rates should continue to suppress the relative appeal of equities versus fixed income. Point number three, the US macro viewpoint. Okay, so here we look at GDP. With the GDP grew by 3.3% in Q4 of last year at a seasonally adjusted annual growth rate. This resulted in a full year growth of 2.5%. On the demand side, a strong labor market and a cushion of savings have helped support consumer spending. However, longer run fiscal programs have helped support investment. A burdensome cost of living and elevated interest rates remain headwinds to growth. Our global research expects the Q1 GDP growth of 1.0% and 2.1% for all of 2024. Point four, we're looking at global growth. This is important. Diverse headwinds face the global economy. In the European area, we have a very strict monetary policy, which has factored in slowing economic growth, while fiscal policy is tightening in Germany. This inflation has also subsided through conflicts in the Middle East, which have raised uncertainty. In China, on the other side of the world, officials have taken steps to loosen the regulation and credit is more available, among other measures. This is going to help combat weakness in the property market and financial stress, which has fueled concern over the outlook. Back to the United States. There remains economic resilience in general, but after the growth of 3.5% in 2022, the global economy is expected to have expanded by 3.1% in 2023, and it should grow by another 2.8% in 2024. Our global research tells us that this compares to average growth of 3.8% from 2000 to 2019. In these 10 years, and this is facts from the IMF, the International Monetary Fund. So negative, I forgot to tell you. The last point is the US monetary policy and inflation, interest rates, right? Recently, the Federal Open Market Committee, what we call the Feds, adopted a more neutral monetary policy stance and has adjusted their communication with a bias towards easing. However, the chairman, Jerome Powell, signaled the need for greater confidence in a sustained decline in inflation. And this disappointed the market expectations of a policy rate cut in early spring. But for 2024, Soriano Global Research expects three cuts of 0.25% to that policy interest rate. And this is going to take place in June, September, and December. So this would take the target range of 5.25% to 5.50% presently to down to 4.5 to 4.75 by the end of the year. So this is positive news. And I hope this helped. Again, send me the questions, whatever questions you may have on these topics, and I'll be happy to give you further insight and illustrate such a thing. As for now, keep liking us, keep sending questions, keep communicating with us. You know, corporate@sorianogroup.com is where we get all your questions, and I'll be happy to address them as we expand our world of Soriano's viewpoints. Ciao.